some amendments to. Just for clarity, the panel has called this in after the first reading, which was passed before it comes back to the States for the second and third readings. Let me just introduce myself. I'm Deputy Montfort-Taddy. I'm the chair of the Economic and International Scrutiny panel.
I am Deputy Max Andrews, the panel member.
And online, we've got Deputy Karen Wilson of St Clement, who's, as I said, she's going to be here for the first half an hour. She'll have to leave us, but she'll be listening primarily, but also potentially asking questions as well. So thank you, Karen. So first of all, could you begin by, and I should let you introduce yourself just for the record.
I'm Ian Gorse, Minister for External Relations and Financial Services.
I'm Elaine Miller, Assistant Minister for External Relations and Financial Services.
Thomas Wright, Associate Director in the Financial and Professional Services Unit.
Thank you. And just to clarify, Deputy Miller, you're leading on this piece of work in the sense that you presented it to the States Assembly.
I was rapporteur, yes.
In your role as Assistant Minister
Yes.
for External Relations, Financial Services. Thank you. So if you're happy, I'll probably direct the questions to yourself, Deputy Miller, but of course, any of you, and especially Deputy Gorse, can answer if it's more appropriate. Could you begin by explaining the primary objectives of the draft Banking Recovery and Resolution Amendment?
The principal objectives of the law that was debated is really to try and bring together the Jersey Resolution Authority and the Jersey Depositors Compensation Scheme Board, because they've evolved separately. The Deposit Compensation Scheme was set up in 2009, 2010, and then the Jersey Resolution Authority followed when the Bank Recovery and Resolution law was passed, I think in 2017. So we have two bodies who there is some degree of overlap with their functions. There is potential as separate bodies for some degree of inefficiency in terms of there being, and I don't like to use the words bank failure, but if a bank did go into effectively an insolvency, bringing the two bodies together will mean for a simpler, faster, more efficient process. So there's the merger of the two bodies, which makes complete sense, and there are also some administrative changes to the way the deposit compensation scheme works to make it more efficient and better, to give a better experience for depositors in terms of allowing, I think the law at the moment requires depositors to apply for funds from the scheme. So we're working on a system which would mean that the Jersey Resolution Authority, if a bank was in that place where depositor compensation scheme was triggered, because the scheme will continue, it will just be run by the GRA rather than the DCS board, they would be able to just make payments straight away. So depositors wouldn't have to go through the additional step of making a claim. They will capture information from the banks that will enable them to pay the cheque. They will know who the eligible depositors are, and they will be able to pay out. And then I think there's some other relatively minor administrative amendments to the scheme.
Thank you. Minister, during the debate on the 9th of July, it was mentioned that the current arrangement of having Depositors Compensation Scheme Board and the JRA are neither are necessarily proportionate for the jurisdiction of our size. So what's going to happen to the DCS board? Is that still remaining?
The DCS board is still in place, both organisations. So the DCS board is still there, the JRA is still there. I think we have a common chair. Mr Mitchell, who's the chair of the JRA, is also now the chair of the DCS board, I believe. He's certainly on that board. The DCS board will continue in place. There will be the merger will take effect.
If so, I can jump in at this point, maybe. So I think whilst they're coming together, so the intent is to bring them together. As we mentioned, the chair is over both, and there was some intent behind that, so that there was that crossover with the strategic view to bring it together. I think The DCS board will be wound down though
Yes,
post
yeah,
transfer.
we would actually.
So the transfer will occur, and then the result is to have one. However, it won't happen straight away because, from an accountability perspective, there will need to be the final period set of accounts by the Depositors Compensation Scheme board. So we're allowing them what we're calling a residuary period, where they have very limited powers. The powers for compensation are removed away from them, but the responsibilities for overseeing what's left of their assets to deliver that final set of audit accounts and the responsibilities there will remain with them for that period. And once that period is done and the accounts are with the Minister and then presented to the States, we'll then have a commencement order to essentially repeal the remaining bit of legislation and dissolve that.
And is all that set out in P42? Is that?
That's explained with, so that's set out in it, and I think that's why we have a commencement order mechanism. There's one of the final articles which addresses the repeal of the current regulations. There's also an article which addresses the deletion of Article 37 of the Banking Business Law, which is essentially the place within the banking business law that sets up all of the compensation scheme, because we're taking it out of that law and we're putting it now into a completely different law and everything else. So it doesn't need to be within that law. So that it's all within there. And I think the commencement mechanism allows you to kind of identify these are the ones that we're going to trigger at the transfer date, and then at the later date we'll trigger the remaining those remaining ones to actually repeal the law completely.
Thank you. And if you haven't done so already, can you advise the panel how the proposed single authority will ensure the Jersey framework continues to align with international standards, including the core principles of the International Association of Deposit Insurers?
Well, they will. I don't think there's any question that's not the case. The scheme, apart from the kind of administrative enhancements, the scheme will continue to exist in its current form with some measure of administrative enhancements, and they will continue to keep an eye to international standards in terms of operation of the scheme. But we would, our anticipation would be that the scheme is very unlikely to ever be triggered because of the resolution framework that now exists. So that is an additional, the fact that we now have a clear resolution framework means that the chance of the type of bank where local people have money going into the scheme being triggered in one of those banks is I would say very remote, and the type of banks which would go into insolvency are not the locally significant banks that would have significant numbers of local depositors.
Can you explain how having the resolution authority makes it less likely for banks to fail? Is that what you're saying?
Yes. Well, the resolution authority will already work with the resolution recovery law. I can't remember that's the right order. It sets out a framework for if a bank becomes, let's just say, unstable, if it becomes financially unstable, the resolution work, and that would be identified by virtue of information that the banks provide to the regulator and to the resolution authority. So there would be alarm bells ringing quite early that a bank was struggling. That would allow resolution tools to be used. It would allow the resolution authority to go in and look at actions that can be taken to return that bank to a solid financial footing, or certainly to avoid a disorderly wind down and loss of depositor funds. So the fact that there is a resolution framework, which again I do believe meets international standards. We had a close eye to Europe and the UK, I think, when we were designing that law. I was very involved in that for a while in a previous role. And it will allow steps to be taken to basically stop the bank becoming insolvent, because insolvency is in no one's interest.
Can I just ask you about that? Because we've also got the transcript here from the 9th of July and your summing up comments, and you did refer, of course, that I think you said that you were involved in the very early consultations. Could you just tell us what your involvement was at that stage?
Well, at that time I was the Viscount, and the Viscount is the, I suppose, you could say the Viscount is Jersey's insolvency officer, so the Viscount runs disaster proceedings. So because it was we were potentially talking about insolvency of banks, the Viscount had a clear interest in what the law was going to say. And I think ultimately, we had lots of discussions about what role the Viscount would have if a bank failed, which struck me as being it's very unlikely that a disaster of a Jersey bank was likely. And I think what the law did, my recollection is that the Recovery and Resolution Law specifically says that a Jersey bank cannot be put on disaster, that you have to follow the resolution mechanism. And again, that is for good reason, that a disaster in terms of a bank would not give the best result for depositors or anyone really.
So I don't really want to preempt too much my questions that we might ask later, but is it fair to say then, because you think that the chances of a bank going insolvent in Jersey are so low, and probably lower than most other places, or many other places, is that would you say that the main reason we have a scheme in the first place is for compliance rather than for practical necessity?
The deposit compensation, the DCS, the scheme itself, I think was set up in response to the financial crisis in 2008 and in response to what was happening elsewhere in the international environment. I think it's fair to say that it wasn't just plucked out of thin air. I remember being involved in consultations about a deposit compensation scheme in the late 90s. So the discussion about a compensation scheme had been ongoing for various levels of enthusiasm, shall I say, or activity for quite a long time. But I think after the counter banking crisis, that accelerated that work so that we did have a scheme in place. But I think the reality is when we go into the policy behind the Recovery and Resolution Law, many of our banks operate as branches of much bigger organisations. So the chances of, I personally think the chances of anybody putting, say, a branch of one of the main UK banks on disaster is an absurd proposition, because you would put the whole bank into disaster. You can't make a branch on disaster or bankrupt.
And does the fact that a Jersey bank's ring-fenced, and does that have any...
Does the what, sorry?
A Jersey bank's ring-fenced in a sense, is that different?
No, you confuse it.
That's
the term ring... Well, sorry,
no, you carry on.
No. So the term ring fencing is something that the UK did in relation to what sort of assets and accounts you can have within certain types of banks. And so the big retail banks that we have, UK retail banks that we have in Jersey, they don't all have the same approach. Some are in the ring fence, some are outside of the ring fence. But that's their internal decision about how they're going to structure, because where they want to raise funds from around the world.
So what you're saying essentially is that you can...
That's separate from a resolution authority, which a resolution authority, as Dr. Miller just said, 98% of Jersey, I think it's 98% of Jersey in-scope deposits fall within systemically important banks in their home jurisdiction, and therefore they would fall under that resolution authority as well. That's why that cooperation between resolution authorities, what we've got here and elsewhere, is really important.
But the limit we're going to get onto later, that is a Jersey limit which is applied where the bank account is held. So just because it may be a UK bigger branch, a bigger bank that you have, is still the £50,000 that we're talking about at the moment that's applied.
Yes, but that's confusing two different things, because resolution is not about paying out depositors. Resolution is about keeping the bank alive and kicking,
absolutely.
So you never get to have to pay out those
we understand.
deposits.
Thank you. Okay, I'll pass over to Deputy Andrews.
Yes, thank you very much. Minister, I just want to start off just by asking you, what is the current process should a bank fail in Jersey, and what changes could we potentially be seeing in what is now being proposed?
I think the chances of a bank failing are remote in Jersey, partly because, as Deputy Gorst has just said, many of our banks are part of organisations which are systemically significant in their home jurisdictions. And those banks, I cannot see, I would find it difficult to see a situation where, a branch of a much bigger organisation is unlikely on its own to become insolvent because it is part of a much bigger parent, and the parent, it's a much bigger entity. But then when you look at a bank here, and there are one or two which are set up as separate subsidiaries, they are still a subsidiary of a much bigger organisation. Now, the failure of a Jersey subsidiary may not of itself make the whole group insolvent, but it creates a massive reputational risk. And for a bank, a systemically, globally significant bank, to say, we are going to allow that company down of our subsidiary to fail, it seems very, very unlikely. And what we don't have in Jersey, we do have we don't have private independent banks. In places like, I think particularly America, you could have what somebody would say, mom and pop banks. You could have small banks which really operate in a very local area. They really do depend on deposits coming in to do their lending. They have a very unsophisticated model. Those are more likely to fail. Our bank, we do not have those types of banks that are owned almost by individuals. We don't have that. So I think we are looking at sound organisations, and we have the resolution framework. So we would recognise, we wouldn't suddenly, I can't see a situation where someone would turn up at court completely out of the blue and say, we're going to appoint a liquidator of this bank without either the FSC or the Jersey Resolution Authority knowing. And if it was a non-voluntary, because the bank could always decide to wind up and liquidate on a solvent basis. The Resolution Authority, the regulator would know, and the resolution framework would be brought to bear to try to get that bank back on an even footing.
So it's in the resolution framework, basically. The answer to your question is it, but it's very technical because if you're thinking about resolution, there are a number of options that you can think about in order to resolve the situation so that the bank remains. But we now have this regime in place, and bringing them together is helpful in this regard, that the first option is for a viable bank is to resolve it. So you may be talking about finding another institution to take over assets or liabilities or all sorts of different options that the resolution authority will follow best international practice and work with home country resolution authorities or central banks in order to deal with that. Now, my next question, because it's very important to hear what you just said there, Assistant Minister. But are you both satisfied with the other jurisdictions where these global banks are based, that they have adequate protections to make sure that the banks do remain solvent and that there potentially are no systemic issues, that should they fall, then some of the Jersey branches could then be affected? Well, I think we're as confident as we possibly can be because of the regime that we've got in place and the work that the Jersey Resolution Authority does with its international counterparts, particularly if you think the systemically important banks in Jersey are also systemically important in their home jurisdiction. And their home jurisdiction, I'm just trying to think off the top of my head, are
you're dealing with the Bank of England.
But they're G7 countries where their central banks and resolution authority are following best international practice. I mean, and we remind ourselves that during the financial crash in the UK, they didn't let systemically important banks fall over. Prior to having these systems in place, they actually, the taxpayer stepped in and bailed in, you could say, to ensure that they did remain. So I think that gives us and can give islanders a very high degree of confidence that the home jurisdictions are going to act in the way that we would expect them to act.
Obviously, we've got the authority in place for a good reason, as do other jurisdictions as well. But would you be of the view that there are probably things that potentially could happen that are not within the control of the authority that could lead to implications for depositors in Jersey should issues arise elsewhere in other jurisdictions?
Well,
Such as the banks collapsing, and then that could have a systemic effect across the banking system.
And so, is there going to be a bank failure in some other jurisdiction that then will have a knock-on effect to the home jurisdictions where our banks are systemically important? Is that the question you're asking? Because if it is, the answer actually is just the same as the one that I've provided, which is those home jurisdiction regulators are going to act in a way that maintains and preserves their systemically important banks.
Well, they may.
Whatever might happen. Yeah. Well, we do know from experience.
It was still a political decision, but past political decisions don't necessarily. You could have a different government which says actually we're going to let the banks fail.
No, firstly, they've got resolution authorities in place now which don't let the banks fail, that actually resolve them and have all of these measures in line with international standards to ensure that the banks things don't happen in the way that they did in the financial crash. But you say we don't know. Well, you could say that to any future event, decision, conversation or anything. The only thing that we can look to actually is they've now got resolution authorities in place. We can have confidence in that because it's the law of the relevant lands. And secondly, when things have happened in the past, they've not let those banks go into liquidation, and they've taken many steps to ensure that it doesn't happen in the first place by restructuring of the banking system, but also the resolution authorities that they've got in place.
And also, I think, you also have to remember that even if there was a parent, if you're looking at a Jersey branch, a failure of the parent does not, the Jersey depositor still has rights against that bank in Jersey, and they can't just say, well, we're going to ignore Jersey and funnel all the money into the UK. That Jersey still have rights as depositors in Jersey with that branch.
Tom, did you want to do?
So I just wanted to mention, obviously, I think it's just to remind the resolution authority will be working to mitigate the risk of bank failure. So with risk, it's about constantly assessing what's there and developing that framework, and that's how any framework tends to operate. With regards to the fact that how another country might respond, well, the resolution authority, a large amount of their work is to engage with foreign resolution authorities or home resolution authorities, but it's not just a case of a political decision determining how a jurisdiction may respond to a bank failure. That may have been a bit more how it would have played out in 2008. Now the banks will have resolution plans in place, and this is part of what our resolution authority has been doing for its inaugural years, is making sure that resolution plans are in place, but also that they consult the group resolution plan, or at least try to seek to understand how that will work so that they're fully aware of the risk that's exposed. And that's the importance of having a strong resolution authority which has the skills, and that's what we believe we have.
So essentially what you're saying, just to recap, is that you're not saying that it's impossible that banks would go into failure, but it's just much less likely nowadays with all the frameworks that have been put in place internationally, and that the Jersey type of business also makes it less likely for a bank to fail. That then leads to the question, I suppose, is do we still need a depositor protection scheme in Jersey?
I think once you've created a scheme like that, it's very difficult to remove it. I think having it is a good idea. Having it will give anybody who is still nervous about lived through the 2008. Anybody who's nervous about that, it will give them comfort, and it means that Jersey is still keeping up with international standards, because other jurisdictions have them, and it would be quite peculiar to remove it. And I think the fact that we don't necessarily, that we can be confident that we don't think it will be called on, but having that mechanism there in a worst case scenario is useful, and I wouldn't, I think it'd be a difficult thing to withdraw now.
How much?
There is also the element of systemically important or not. So if something if a banking institution isn't systemically important, then the approach taken to resolution would be different, and therefore in that instance you do need a deposit compensation.
So because it may not be systemically important, but if it's your deposits held with that account as a consumer.
That's why you need the deposit compensation scheme.
Although I think that the reality
But
is...
are there many of those
that
banks?
The reality is that there are several banks on the island. There are banks, but if you went in and said, I would like to deposit £10,000, they'd say, no, go and talk to one of the ones on King Street. You know, they are aiming at a different type of depositor than local residents.
So there are banks in Jersey which you'd say are not systemically important.
There are definitely banks on the island that are not systemically important to Jersey. I think one of the things to recognise is that the typical banks that most people would bank with would be systemically important, some of them globally systemically important. So that would naturally put them down the resolution route for mitigating failure. If you're then, if a smaller bank that isn't systemically important to Jersey, and therefore that essentially infers that it tends to be of a smaller nature, or probably not necessarily as important to the continuation of business in Jersey, if it were to be removed from the landscape, then that would essentially be allowed to take more of an orderly dissolution.
Is the JRA still going to provide mitigation to a failure of that type of bank?
Yeah. So I think one of the things, so with failure, it's not that it's just the Jersey Resolution Authority. Currently, the landscape's quite broad. So I think one of the things we were mentioning earlier about the types of bank, well, the first protection that a jurisdiction has is its licensing regime to manage the risk that the jurisdiction is exposed to. And then as you work through this prevention, so there's work that the competent authority, the JFSC, actually performs. And the resolution authority during that kind of preventative phase will implement things such as minimum financial buffers within banks, as well as ensuring that they have resolution plans in place to mitigate the risks that a failure will present. And before even moving to resolution, there's also an early intervention phase, and there's a role there for the competent authority. So in Jersey, that's the JFSC to get involved, and that can be anything from taking control of management through to providing other support and provision. So there's a whole suite of things to reduce the risk of actually getting to that space. And that's why it's all very complex. But these things have been developing since 2008, 2009, alongside, obviously, this existence of compensation scheme.
The other thing I'd say, just to add to that, is that even if there are a small number of banks in Jersey which aren't systemically important to Jersey, and the point that Deputy Miller made about what sort of criteria they use to access their client base, they are I'm trying to think, in all instances, systemically important to their home jurisdiction as well. Mm-hmm. So it's not just whether they are to us, it's also whether they are to their home jurisdiction. And that again comes back to that point of cooperating with international resolution authorities and central banks.
So one of the main points we're trying to grapple with as a panel, and perhaps the Assembly is as well, is if the scheme is necessary and we want to get rid of the scheme, what is the correct level of compensation to protect? Is it always going to be £50,000, which it was in 2009? Is it less than that? Is it more than that?
So that I know that from a perspective of comments that you made in the States Assembly, it feels like it should be an easy question to answer. Our position is that we will need, and we do need, a depositor compensation scheme, and actually it will function more, should it be needed, it will function more effectively and efficiently to those that need it, because you'll have this direct processing rather than having to apply. So there's lots of positive changes. The question about the level isn't straightforward for all of the reasons that Deputy Miller articulated in the States Assembly, but we accept and we agree that a review of it is a good thing to do. You've asked us that question, others have asked the question, and doing that review is an appropriate thing to do. But we shouldn't, I don't think we would want to second guess what the answer to that review might be, whether it should be lower or higher.
But the review is presumably based on the fact that you think that there's something that needs to be reviewed. And are you reviewing the sum, or are you reviewing the mechanism which would be required in order to increase the sum protected?
So you can't just look at the sum without looking at who's going to what the levy is going to be, what the state's loan or guarantee would be connected with it, and a better understanding from banks as well about or another look at deposit levels, etc., and all those sorts of bits of information. So
but
it's not just a straightforward.
But you wouldn't you wouldn't review something that you didn't want to do, though, would you? You'd accept that there's a political desire to increase.
Well, there's a political desire to have the
consider.
To have the review, and then
But you wouldn't have a review for no point, though, would you?
Once you have the review,
You wouldn't have a review if you didn't want to change anything. You'd only review something that you want to, that you're considering changing.
Not necessarily.
No, because you
If you were happy with the £50,000 limit and the scheme's working well, you wouldn't bother having a review, would you?
No, I don't think that's
Still review to see whether the limit is still right. Now, you could do a review of what your limit is. What we're trying to do here
That's the same
is
thing
to
then.
get the
That's what
scheme
what I'm
effective.
saying is, if you were happy with the £50,000, you wouldn't need a review, would you?
We have said we would review it because for exactly the reasons that you've said. It has been in place for a long time.
Yeah.
It is right to review it occasionally and say, have we still got the level right? Now, the level, we may conclude from that review that the level is still right for all, taking into account what the banks feel like, what the levies are, how you fund it, what the impact is. And there is nothing wrong with reviewing and saying, well, actually, what we've got is still right.
But can you articulate clearly what the motivation is for the review of the sum of £50,000?
It is checking whether it is still the right amount.
Why wouldn't it be the right amount?
Because things have changed. It may be the way, because of, in the whole context of where we are comparably with other people. We are at the moment comparable with
It's really just a reality check. Can you articulate the fact that we've had 16, 17 years of inflation since 2009? And therefore, the figure of £50,000 is not, in real terms, what it would be worth
but
to somebody.
Equally, inflation, I think, just to say, we'll just
I mean,
we'll just put it up. I don't accept inflation is the right measure at all, because if you say, well, my savings have gone up by the level of inflation, that's, if everybody's savings had been index linked, if people have still got, if in 2009 the average deposit was 10,000 and now the average deposit is still 10,000, then there's no obvious need to increase the limit. If we looked and found that the average deposit had gone up to 80,000 or 90,000, you might think maybe 50 is not enough. So
when you talk about the average, which average are you talking about there?
The average deposit.
Are you talking about mean, the median, the mode?
I'm just talking about an average deposit. What is
there
the
isn't
sort
an average.
of...
So what kind, are you talking about the mean
There
sum
is an element.
deposits?
I don't really... I can't
relevant.
remember what means and medians are. Tell me what the mean is.
Well, the mode is the general. The most deposits will be in this particular sum. So
Well, if the mode is 15,000, there is absolutely no need to increase a limit of 50 because the majority of people will get their money back under the scheme.
So are you going to have to
So
do all
there
that
is
kind
no
of research
point.
to find out exactly how many bank accounts are held, how
Yes.
much is in each bank
Yes.
account?
Well, you would look at how much in each bank account, you would look at the total amount of depositors, where the depositors are.
But do you have the support of your ministerial colleagues to look at this? I mean, do you need the support of your ministerial colleagues?
We don't need the
We don't need the support.
support. It
It's
is,
you got,
it is a number of years since it was reviewed. Other jurisdictions have increased theirs over time, although comparable jurisdictions largely have remained as at 50. But that it would be right for us to, because of that length of time, to do this review. We know that in the EU, although they've got euros double what our 50 is, they've got €100 threshold. They reviewed it in 2014. They actually maintained theirs at the same level, but we know that the UK has got plans to increase it. So I don't think there's anything inappropriate about doing the review. I think it's the right thing to do, but you do need to understand, particularly the mean level of deposit, to understand whether it does need to increase or not, and then understand what are the implications of making that change.
So how important is your engagement, for instance, with your counterparts in the Isle of Man and Guernsey when you're doing this review?
oh, well, we would engage to see what they're doing.
So the first thing is we'd ask the authority to do the review, because they're the ones that have got the most information now and got the most expertise in this field. It would be fundamental to understand what's happening in Guernsey and the Isle of Man, albeit, of course, we remind ourselves that their finance centre, their financial services base is different from Jersey, and so you have to factor that in as well. Their numbers, mean deposits, etc., could be substantially different from Jersey's as well. So it is important that we have that engagement and that the authority will engage with them in the course of this
If there was
review.
a differentiation between the deposit thresholds that are set between the three jurisdictions, if say Jersey was to increase the threshold, what potential impact do you think that would have, or would it not?
Well, they're the questions that we would want answers to, because we know that are systemically important. Some of the big retail banks have operations across 3 islands. Some subsidiaries here in Jersey have got branches in the other Crown dependencies as well. So it was important that we would have a joined up approach, but there are potential differences that might mean we have a different approach, but I think it'll be difficult for us to take a different approach because of those synergies.
Can I just ask, in 2009, when the £50,000 cap was selected, what basis was that chosen on?
I don't know, I wasn't involved. I imagine it would have been done on a comparable basis with other schemes that existed at the time.
So could we not apply the same logic nowadays? Because I think when that £50,000, I suspect you're correct, it was done because that's what initially the UK scheme was. The UK scheme then very quickly came up to £85,000.
So whilst I think there's a level of looking at what other jurisdictions are doing, and I'm trying to recall what I've actually seen in terms of the files with regards to what was done in 2009. You appreciate it's a long time ago. There was actually work commissioned with the very people that were advising the UK on where to set their levels. So there was work actually working with them, but it was very much looking at Jersey and not necessarily looking at, oh, this is what we've done in the UK, take it here. So there is consideration. I think it's not just about looking at averages and means, and there's also consideration as to actually, so part of the actual data collection work is actually to go out there and say, we need data of how many deposits are at that higher level then, and therefore what's the coverage and who's the coverage. So it's getting a full, more rounded, holistic view of it so that we can inform a better decision.
Can I also ask as well, I mean, how much is being generated from the banks with the levies?
So the answer to how much can be raised by levy is one is dependent on which bank has actually gone into failure. A large bank going into failure, then that's a bank that's not going to be levied. But the amounts that you're really looking at are around 53 to 56. On top of that, you've also got
Can you
the
just specify what your unit?
so million pounds. as well.
Is that what's levied, and at what point does the levy take place? Is this
The levy will take place over a period of 5 years. So the way that it works is that the state's loan would.
It's
be-
when, sorry, Tom, it's
go
when
on,
it comes
pause.
into, the levy will be charged at the point the DCS scheme is triggered.
but
Yeah.
from the
So when
ones
there is a
who-
need
yeah,
for the
but
money,
from the
that we're
banks
not
that are not
taking
going into
Yes.
levies.
From a healthy
Remaining
bank,
banks, yeah.
And the scheme's funded by, so it's not a pre-funded scheme like many other schemes around the world, and therefore that's one of the big reasons why you have a state's loan, provide that liquidity. The liquidity will be there for day one to get things up and going and to get compensation for payouts moving. The levy then will come in and will
So there's no
offset.
initial cost to the so if for example we were to decide, ministers were to decide to increase the compensation limit from 50 to 85,000, there's no initial cost to that. It would only be
Well, there would be,
there would-
yes,
there'd have to be,
because there is a contingent liability.
Yeah.
There is a contingent liability, which means, as is apparent, I think, in the budget every year, there is an amount that has to be earmarked in the event of being called on.
Yeah.
So there is a cost to
money
government,
that can't necessarily
and that
be
has
used.
a knock-on cost to what government can use that money for, what it can borrow for. Because if we increase the limit, then the state's loan would have to increase, and that means.
And is that a consideration
less-
as well? Is that you don't want to tie up money that you
Well, I
might be
think it
needed?
would have to be. We would have to take into account what it means for the public finance.
Is that because public finances are a bit strapped in the next year?
It's because it's a big chunk of money we would have to pay out, and if we have to hold that money on reserve, we can't then allocate it for other spending.
Okay.
It's not to do with the state of government finances. It is a contingent liability that would have to be funded. So that has a big impact, because if we can't then use that money, if we've got to pay money out, we can't use it to fund other things. We have to have it sitting there, available.
So can I ask, I didn't mean to cut you off, Thomas, but have you finished your point?
I believe so.
Yeah. Okay,
So
sorry.
if it becomes apparent that I haven't, I'll take the opportunity.
So can I ask then, ministers, about the, when do you anticipate this review could be carried out realistically and then concluded?
I think we anticipate that the JRA will do some work on that. It's within its remit for it to go and do some of the underlying sort of research, if you like, in terms of what our limit is, how it could change, comparable work. And I would anticipate that happening, I think, towards the start of next year.
It was
Or
the
happening
second
next
half.
year. Or the second half of next year.
uh,
Sorry, I meant the second, not the start. That
Yeah.
was the wrong.
We have got a
latter
submission
part.
made from you, which I presume is a public submission. We were just talking about that before the meeting, so, and there's no reason to presume it wouldn't be a...
We have assumed that as your letter to me would be public, my response to
Indeed.
you would be public.
So to just confirm, because I do remember, so it did say the second half is when you would anticipate
yes.
starting it, and it would maybe be concluded by the second half of, by 2027.
Yeah.
Yeah.
And the problem I think we've got as a panel with that is that, of course, it's not, the second half of next year is potentially after the election, of course, so there will be an election in the
Well,
first half of
it's-
next year.
But I think we've tried to explain it as a very complex matter, and to try to push something through before an election for the sake of an election is
Well, how would it go so far as it is a work programme that they will be given at the start of 26 to do the work in 26? I'd be very surprised that a newly elected government would come in and say in September of 26, which would probably be the earliest time they could do it.
Yeah.
So they would say in September of 26, I'm sorry, Jersey Resolution Authority, we no longer want you to do that work, because it would be in their work plan for 2026. It doesn't seem credible that one of the first things a new government would do would be stopping
Well, they
a
might
piece
stop
of
it.
work.
They might stop it if it hadn't been started by the end of June, and then there's an election that takes place at the beginning of June, that they may well not proceed with that. So I think
No.
what we're
No, but
saying,
it's
Well,
part
I don't
of
see
their
how
remit.
that would be,
They-
because you give bodies like this don't just come and ask the minister, right, what do you want me to do this week? There's an agreed work plan with these sorts of organisations, and they get on with it. It would require an incoming minister to decide after an election that they no longer wanted the resolution authority to do the piece of work. And that it seems to me incredible that an incoming minister would do that.
I think what the panel would say is that we would find it much more reassuring if there was a commitment to start the review in the first quarter of 2026, not in the first half of 2026.
But in the first quarter, they will be dealing with this piece of work that is envisaged by the law in terms of making the changes to the scheme, merging the two bodies. That is work. That is work that they already have to do, and that is the work that has to be done as a priority. That we're aiming to do that work first to make the scheme efficient before they then think about whether the limit is. And as we've said, the limit could, the outcome of the review could be that the limit is absolutely fine. And we don't need to change it.
Is the panel really asking that the work be commenced before the election? Because they've got to do this piece of merging work. That's for all the reasons that we spent this hour discussing. The resolution, making sure that the resolution authority and the deposit compensation scheme are brought together so that it's more effective and efficient for depositors if it's required. That has to be the priority. It's been the priority for the last number of years. It's eminently logical that would be. But is the panel really asking that we request that the work to review the limit starts before the election? Just to be clear, because we can then go away and consider what could be done.
Clear. We've identified what we think is an issue of public interest around certainly around the £50,000 limit, which seems to have been eroded. RPI has been 67% over that period, and the people we've heard from in public submissions saying yes, absolutely, that limit should be increased.
Have they said that their deposit has gone up by 67%?
So
I mean, that's deposit. It has to reflect deposits.
I think the implication is yes. Otherwise, they would be quite happy with the £50,000 if it covered all of their savings. But we can come back to that. So I think it's up to ministers to decide how they get the information that they feel that they need to get it. It is questionable indeed whether the JRA need to do that work. You could argue it's completely inappropriate for the JRA to do that piece of work when they are the resolution authority themselves, and that there should be bandwidth within government to do that work.
But as a consequence of this, they will be running the scheme. So it's their scheme.
It is their scheme.
And it is appropriate. It will be.
But ultimately, this is a policy decision for ministers to make as to whether they want to increase the limit and whether or not what the implications would be for that. So
based on appropriate, accurate, up-to-date understanding and a review of the current limit, doing all the work that we said, it is absolutely appropriate that the resolution authority does this work, because they are now the Jersey experts on ensuring that banks, if they're experiencing difficulty, can be resolved appropriately so they don't fall over, and B, for those non-systemic institutions where they can't be resolved, where they do have to go into liquidation, that the depositor scheme works well. So they are absolutely have a vested interest in making sure that the limit is appropriate for Jersey. So their advice, the work that we will ask them to do, is absolutely the right thing to do. Banking in Jersey, the implications for the state's loan, therefore the cost to taxpayers. And is it just, and who is going to benefit from that? Because your average saver and the average citizen that currently doesn't have up to 50,000 in a bank account, ultimately you could argue, well, the taxpayer is going to pay more, cost of banking is going to increase, and your average saver will see no benefit. So it's not just a straightforward, we introduced it back in 2009, and RPI has increased, therefore we should increase it. We've got to consider all of those things in order to inform the decision.
I think you've heard the position of the panel, so I'll leave you consider your timelines. Could I just ask the Deputy Miller? You said something during your summing up on the 9th of July that you were concerned about people outside of Jersey getting access to the scheme. So I think your quote was that if we're sending out cheques to very rich people in the Middle East and people locally are not getting money, that's a difficult political position. First of all, is it an either or? Are we saying, is there any likelihood that just because we have to compensate people at the moment for £50,000 who live outside Jersey, that there's a risk to any local savers?
Well, I think the point I was trying to make is that of all these banks, I believe the scheme attaches to anybody who is an eligible depositor regardless of where they live.
That's the way it should be, is that not right?
That is where it should be, but the problem is many of the people who are not in Jersey will have very significant deposits where £50,000 is a drop in the ocean. But we will be in the position under this scheme of sending cheques to very wealthy people outside the island.
Is there a problem with that?
If it means it prejudices local interest, then yes, I think there is.
How would it prejudice local interests?
If it means we can't fund, if it means because governments had to put up £100 million, which it can't then spend on something else.
So would you be suggesting two tiers? Would you be
up.
suggesting?
I'm not suggesting that. I'm suggesting that would be part of the review.
I'm just not sure what's the relevance of whether someone lives in Jersey or not to the decision.
Well, to me,
increase.
but I think what I'm trying to get to is the optics of it. That we would have a deposit compensation scheme sending cheques to very wealthy people outside Jersey, and there may be people here who have £70,000 who are seeing they will see they haven't got the 20,000. Now the 20,000 is not necessarily at risk. It doesn't mean they won't get the 20,000 back, but in the first instance they will get a maximum of 50. And those people will feel aggrieved by the fact that very wealthy people are getting cheques and they're not getting their entire deposit back.
The rich person
but
might get
we cannot
aggrieved.
give everybody, if the person in Dubai has a deposit of £3 million, we can't give them their entire
Is this a view
deposit.
that you also share as well?
Well, it's a legitimate political point.
I'm just saying you might be more aggrieved if you lost
political points.
If you lost £3 million rather than minus
If you've
50,000.
lost £3 million and you've got £150 million somewhere else.
But if you haven't, I'm saying if you've got £3 million in the bank and you've lost it all, but Jersey says here's £50,000, you'd probably.
I don't believe people who are depositing £3 million in Jersey are doing it because we have a deposit compensation scheme. They are doing it as part of a much wider.
Do you think it should apply to those
management.
people at all?
That the decision that was taken in 2009 was that it would apply to all depositors, and I think it's very difficult. I can't remember. I think it's very difficult to say we will protect some depositors and not others. That's why there has to be limits, and that's why you have to. That again is why simply saying we'll up this by RPI is just far too unsophisticated and doesn't reflect the complexity
But
of
we
the
could
question.
say we're not. It wouldn't necessarily up it by RPI, but we might up it to a comparable jurisdiction like the EU or Gibraltar.
But that has to
or
be
the
done
UK.
in the context of Jersey's economy as a whole, how it's funded, what the implications are for the banks, what the cost of banking is, what the cost of deposit taking is, what the cost to the public is, what the cost of the potential resultant cost to the taxpayer is. It's a very complex equation that would have to be considered carefully. And I'm not saying I would think that if there was scope to think about who is covered, then that is something that could be done, not necessarily in the context of who, what the limit is, but it is a very complex area, which was why it was discussed for years and years and years before we finally got a scheme in place.
Okay, thank you for that. We'll move on, I think, away from that. So, Minister, the draft law requires that the compensation be paid within 7 working days using single customer view files. Can you confirm whether all banks have successfully completed live connectivity tests with the Jersey Resolution Authority to demonstrate that this system works in practice? and would deliver as intended in the situation of a bank failure?
Good question.
So at this point in time, it's the Depositors Compensation Scheme Board that is performing the testing. And they have, so they already require banks to maintain a single customer view file. And they have to date gone through a round of testing to ensure that those banks have a suitable file in place, providing feedback to those banks to ensure that any issues that they have been addressed. And that's a continuous process. It's one to ensure the bank has the right file. It's one to ensure the file can go through the system that the board and therefore the authority, which the authority wouldn't take on, actually works appropriately.
Okay, thank you. I think we are getting towards time, so what I'd like to do is just maybe give Deputy Andrews the opportunity to answer some final questions about cross-border cooperation.
There was just one thing I just wanted to touch upon, and that was just the levy cap of 10 million. So essentially what would happen, just so people at home are aware, any bank with deposits that exceed 10 million, that are 0.3% of their overall deposits, would then be liable for paying up to 10 million over a 5-year period. That'd be 2 million per annum. And I just want to know, how did you arrive at those figures?
In 2009, how did we? I don't know how those figures were arrived at. Probably through discussion with the banks.
And obviously we've spoken about inflation, and we've spoken about deposits, and in particular with the mean of deposits. But do you believe that the figure that has been given to the panel is still good enough, or do you think it potentially should be uprated?
Well, for my part, this is what the review has to cover. You can't just increase a payment threshold without thinking about the implications for the levy. You can also ask yourself, is the levy still appropriate in the current climate, and take it the other way around, which is why I think a review is important and is timely, because it will help answer those questions.
But 0.3% seems to be awfully low, and I just wanted to hear your views on whether you think, if there was a case where a bank's
So the
collapsed, that it should
0.3%
be
comes
increased.
from, just remember where that comes from.
Within the law,
Yeah, but I think it's
I've not
mirrors.
got the who it mirrors. I've not got that who it mirrors, but I think one of the things to remember is you've got the levy, but then what we're kind of making quite clear with the changes that are coming through, is that ability to recover money from the liquidator and make sure that
Can I
can be
just add
utilised.
something? I think the thing is, what we may confuse is the fact that we say 0.3% of deposits.
Yeah, I was just
They
thinking
cannot
about that.
take the £10 million out of the deposit pot. The bank has to find £10 million of it. So if you are a bank who has to pay 10 million, you have to find £10 million of your own money to hand over to the scheme, to fund the scheme.
5 years, yeah.
Now, that's you're not taking that out of the deposit pot. That is your money, and there is a limit to what we can realistically ask banks to commit of their own money towards funding a scheme. And I imagine that's where it came from. This is the bank's money, and not the deposits that we're talking about.
The banks
They have to
presumably
fund
don't
that.
have to keep that £10 million aside at any one point, do they? They could just say, look, in this very
Well, it's
hypothetical situation, we would find that money and make a decision
no,
at the
it's
time.
I imagine for the banks, it's the same as government. It is a contingent liability, and if they think their liability, I would imagine if I was a bank, and I knew I had a contingent liability, I would have to account for that. You can't just say, well, we know we might be asked for £10 million over 5
agree with
years,
that,
so we'll just
Deputy
find
Clerk?
it when we need it.
I'm trying to think back the last time I looked at a bank set of accounts, but I'd be very surprised if those global banking institutions don't have to put a contingent liability for all their liabilities wherever they operate. It would seem very unusual from an accounting perspective.
Could it just be a general liability that they hold, or do you think they specifically
I don't-
account for that?
No, I think they'll have to, well, when you say accounting, they'll account it through,
The reason I ask,
probably not dissimilar to how we have to do it in our accounts. So yes, they've got reserves, but against that reserve is a contingent liability that should X happen, they have to do this.
do you think there could be a different way to do that in terms of, I'm thinking about the states, the government budgeting now. Do you think, given the remote likelihood of any of this ever happening, that it's an effective use to have to earmark that amount every year, rather than just saying, look, if this ever happens, we'll deal with it out of the
No,
strategic
we
reserve?
can't possibly do that.
Don't think we could possibly do that.
I couldn't see a word
We
where
could-
would say,
we could
we have a
possibly.
potential contingent liability of 100 million and we're just going to ignore it and we'll worry about it
But you
if
do
it
it on the
happens.
balance of risk, don't you?
No, I can't see
You
a
agree with
position
that?
where
Because
the
I think it's
accountants would agree.
The problem is it will be an accounting audit issue.
Yeah.
Yeah.
So you know under law you've got this contingent liability, but you're not making any either provision
No provision. No.
or a note saying,
You could just put that as a liability of the strategic reserve, couldn't
well,
you?
that is how it's
it's
that's
done.
how it's
Yes,
dealt with
but
now.
that then means the strategic reserve has to be viewed as minus 100 million, because that is earmarked. You can't just say.
But if we're not using the
we've got
strategic
enough-
reserve anyway, it's kind of academic, isn't
Well,
it?
the strategic reserve comes into play in all manner of
Right.
means.
But that's helpful, because what we're saying is that there's not £100 million extra that needs to be found every year to budget for this. It's already in the strategic
Well,
reserve.
it's in the strategic reserve, but it means we have to allocate it for this purpose, and we can't use it for other things. And
We can't use it
that
for the
is
things that we already
so I
don't
would
use
say
it for.
it basically reduces.
Well, you can't,
the
for
strategic.
example, you're borrowing for the hospital.
Yes.
You're in effect getting the borrowing rate that you're getting because you've got
Because
the
you've
asset
got-
base that you've
yeah.
got.
Yeah. No, that's fine. That's clarified.
So
So
you
thank
can't
you.
use it in that
Yeah.
type of a calculation.
And so to finish up, we won't have got through every question we can. So as usual, if you're happy to receive the questions in a written form, can I perhaps conclude just by saying that have you already started having conversations in this regard with the Isle of Man and Guernsey about what they might be doing with their schemes, or is that something that you anticipate happening in the
Well,
next
I
few
think-
months?
I don't think we've had anything above or beyond informal conversations with political colleagues. I don't think you've had them with official colleagues.
Yeah, just very, very much initial, but not necessarily anything of detail.
Okay. And do you anticipate that Jersey could move alone in this? So if you, I presume, because each jurisdiction has a different landscape in terms of its banking, and ultimately this scheme is here to protect depositors, and we've got to be mindful, I suppose, of how it affects the institutions, but it's there to protect ultimately and to give at least psychological what's the word I'm looking for? Reassurance to depositors.
I mean, it's possible, as I answered to Deputy Andrews, it is possible, but I think it's difficult.
Okay. But if it came back, say, for example, Guernsey, I already presume has a different landscape to Jersey in terms of its banking versus its other financial products. And if it turns out that Jersey has a lot of depositors who are at the, say, £60,000 to £100,000 savings marks in one institution, whereas Guernsey doesn't have that, would that maybe be a compelling case to say we do need to look at increasing?
Well, it's got to be.
I
It
don't
would
think we
be.
can look at it in isolation. That's what we keep saying.
No, but
has
it
to
would be. That's
considered
part of the
broadly.
consideration, isn't
Yeah.
it? That's
And then
what
how
we
does it
said
look to have
about
different rates?
about deposit levels across, and then how would institutions manage that if they, because often they're cross-selling products across the Crown dependencies, and therefore they'd have to have a separate disclosure if that's what they were doing. So that's why I say it's possible, but it's just probably.
But it's not a selling point as such, you've told us. The 50,000, the protection level isn't really a selling point to somebody opening an account and therefore being competitive. So if Guernsey had a higher rate and we had a lower rate, that wouldn't necessarily be a problem in terms of the competitiveness.
No, I mean, you could argue that it depends through which lens you view it, but it's important that we view it through a number of lenses, foremost for depositor protection, but you can also view it through the lens of cost of business, so cost to banks, And therefore, if Jersey's banking offering becomes uncompetitive from a cost perspective to other Crown dependencies, then it makes us less competitive. So we have to keep looking at it through the compensation lens, but there are other lenses that it can be looked through as well.
Okay, that's probably a good place to finish, if that's all right, Deputy
Yep,
Andrews.
that's fine, yep.
Thank you. Do you have any other questions or points for us?
No, thank you.
No. Thank you for attending today,
Thank you.
and I'll just ask for the recording.